Money in entrepreneurship can be very confusing. When do I go out and get investors? When do I just walk into a bank? How do I start to think about all these different kinds of money and the different costs associated with those kinds of money? Okay, today we're going to go through the capital stack. My name is Walker Dybel. I am the best-selling author of Buy Then Build and the creator of the Acquisition Lab. I've been buying companies since 2006. A lot of times I work with banks and a lot of times I work with investors, and so I want to kind of uncover of how I think about money, okay? But I didn't invent the capital stack. This is just how it's thought of. And so if you're starting a business from scratch, if you're buying a business, if you're buying real estate or whatever it is, you need cash in order to execute on the vision and the mission of what it is you're trying to accomplish, right? So down here at the bottom, this is the foundation, okay? This is going to be senior debt. Senior debt. Now, senior debt is what you think of when you go to the bank, okay? The mortgage on your house is senior debt. It's secured, okay? You could write that, secured. Secure, I'll just put sec. So secured debt means there's collateral, okay? And this collateral is basically like, hey, if you don't pay us, we're gonna take your house, okay? And same with a business. You stop paying us, we're gonna take your business. Okay. Now, the thing with senior secured debt is that when there's not enough assets in the business, okay, to make the bank happy, they want a personal guarantee, okay? And personal guarantees with lenders come up most commonly when there's not enough assets in the business, okay? But that personal guarantee is acting as collateral for that senior secured lender, okay? Next, you've got subordinated debt, okay? I'm just gonna write second position, second. So this is subordinated debt. And the point here is, this is a secondary lender, okay, who is in the deal, but they're behind the senior secured lender, okay? Maybe you couldn't get enough debt from the bank in order to execute on this deal, and so you've got a second lender in there, okay? What comes next is actually mezzanine debt, all right? And so we'll put mezz. Mezz debt tends to be, as we'll talk about, expensive, but also short-term in nature, okay? And if you need like a little sprint of some kind to do a certain project. Or the other way people think about it is we'll go ahead and take some mezz debt on, but the way I'm going to think about it is I'm going to blend my interest rate from all the lenders, right? So they try to get a blended rate that makes the whole deal kind of make sense. Blended meaning low, medium, high kind of interest rates. Then you get into equity up here, okay? And so first you have preferred equity. And this is going to be people that are first in line, okay, in terms of any sort of capital that's coming through the business, right? And then you've got common stock. The preferred equity and common stock are both equity, okay? This is equity, all right? And common stock is literally when you go to the stock market and buy shares of Apple, their capital stack looks just like this. It's just that you're buying this one up here. You're last in line, okay? Why would we do that? All these other things, right? So first let's talk about what is the cost associated with each one of these types of capital. And so again, up here is sort of the equity, down here is the debt. And so your senior secured lender, let's just say, over the last 20 years, the most common would be, let's just say 6%, okay? So we've got a 6% interest rate in order to get this capital right here, okay? Then you've got a secondary, unsecured lender. Because it's unsecured, usually the interest rate is slightly higher. I've seen it in line with this a lot of times, like if you have a seller that's doing a little bit of financing on a transaction, their interest rate might be exactly the same, mirrored because of the fact that they are participating in the exit. And so they might be getting 90% of the cash at closing, but they may be holding a little bit of note. So since they got all that money, they might be okay holding the same interest rate. But if we got this from a lender or some other group of debt investors, they might charge a little bit higher. Let's go ahead and just use 8% for that, just to show it's a little bit higher. Then we got mezzanine. Mezzanine is expensive debt. So let's just call that 18%. That's the most common number I've seen over the last 17 years working in this space. And mezz debt often has a lot of strings as well. These are lenders, okay? These are lenders and they're taking a pretty big risk because there's no collateral, but they might like the deal and they're trying to get their money back quickly, but then they might have warrants and sort of, if you exit, we roll in equity and just, all of these types of things that make it a little bit more confusing, right? But it's basically expensive short-term debt that has some strings. Why would people do that? That's crazy, right? Well, the concept here is they think about this and they want to blend it, right? So the 6, 8, and 18, and the mezz will be the smallest amount, and you might end up with maybe a 10% interest rate for a short term until you wrap that mezz up. Now, equity up here, here's how I want you to think about equity. when you take money from an investor, okay, what they want in return is a 35% interest rate, okay? And now this is textbook, okay? Now, some equity investors might want more, okay? If you're working with venture capital or anything else, and you're trying to 10x a business in a short period of time, you can see that. But the point is, okay, is that your cost of capital down here at senior debt is much, much lower, a fraction of what it is up here at the common equity, okay? The trick here, okay, and the thing that gets everybody hung up is that this senior debt, they need to get paid every single month. And so this is a drain on cash flow. It's a liability. It's straight up a liability that sits on your balance sheet, okay? Whereas equity sort of needs to be patient, okay? It needs to be patient. And so we say, look, I'm gonna go ahead and sell you some equity, but I've got to take care of these debt lenders, okay? And this is the 3 to 5 year plan we're working on, and you're gonna give me $100,000 today, and I'm gonna give you $500,000 or $1 million 3 to 5 years from now, okay? And so this is where all of your upside is, okay? And this is where your cost of capital is cheaper, okay? So down here you have cheap, but here's what else I want you to understand is that these guys, this senior secured debt, they are not participating in the upside whatsoever. If you've got your big exit, okay, you're 5 years down, you grew the business 3 times, you go for this big sale, okay, they just get cut out. Their loan just gets paid off and they go home, okay? So they don't participate at all up here, right? So this is cheap debt, okay, and it's low risk to the lender, okay? Up here to the investor, it's high risk, but what? It's high return, okay? Return. When you are doing business, what you want is a high return, okay? When you're an entrepreneur, you're trying to get a high return. Now, look, don't think about it in terms of finance if you don't want to. What I want you to think about is, what is the dream I'm trying to live? What is the value that we're providing to our customers, right? What is the perfect size of the business that I want to own? Or what is the impact that I want to have, right? All of these things are kind of equivalent. If you want to have a big impact, well, your business needs to be sustainable and you're going to have a high return, okay, financial return. So if you like money and impact and growing things, then I want you up here. That's the point, okay? So you've got this up here, and so when you own your own equity, you get the highest return on you and your business and your efforts, okay? So why do startups not go out and get debt from the bank? Because they can't. They can't. And so when you hear someone say like, hey, I've got this startup and I'm gonna go raise money and do all this, the only reason, they don't even understand it themselves, but the only reason they're having to go out and raise equity is because they don't have any infrastructure. They don't have any customers. They don't have any technology. They don't have any of these things, right? And so the concept is that they have to go out and exchange shares of their company, okay, in exchange for money. And the thing is if the business works, they sure wish they didn't sell their equity, okay? Now, if you're gonna buy an existing company, you can go out and walk into the bank, leverage the existing infrastructure, the track record, the revenue, talk about all this and buy then build, right? That's what I've been doing for 20 years almost. And so the concept is you walk into the bank, okay, you get this piece, okay, and then you put a little cash infusion in or a partial seller note or maybe a little bit of it from investors to cover the equity that you need to go down, and then to infuse, I should say. And then if you don't take on investors, you keep all of the equity. So really, your capital stack, if you're buying a business in this sort of like buy then build model, okay, what's gonna happen is your business is gonna look like this. Your capital stack at your business, on the day that you close, okay, on the day that you close, you're gonna put, let's just say, you're gonna put 10% down, okay? Highly leveraged? Yes, okay, it is, but you're getting all the equity, okay? So here's the thing, you're putting in equity, and this is no one but you, all right? And then you've got, up to 90% senior secured debt, all right? That's all coming in at 6%. This is what I've done 7 times over, okay? And the concept is, as you pay down the debt, okay, And so look, I get all this cash, I get 90% at this low interest rate, right? And so as you pay down the debt over a 10-year period, the equity increases and the debt decreases, okay? And so you've got this sort of equity buildup, just like a building, okay? And that's why I like acquisition entrepreneurship. It brings in the economics of real estate investing, right? And so ultimately, once you have all the debt paid off, you own 100% of this equity, okay? Or if you build the business, and let's just say you grow up by, 3x, or pick your favorite number, you grow at 300% in 4 years, for example, you can just go and sell the business, and your equity is now so valuable that the debt piece that you originally bought it for is such a small amount. So this is why I've always liked acquisition entrepreneurship. If this makes you nervous, you can follow what private equity does. And private equity says, okay, we want 50% equity and 50% debt so that we can get this blended weighted average cost of capital, be secure in terms of rocky markets, and also get all the upside of the equity buildup. If you want to buy a business in the next 6 to 24 months, please check out the Acquisition Lab. We are the premier accelerator for helping people find and buy a business. Check it out, acquisitionlab.com. See you on the inside.